WW International, Inc. The company formerly known as Weight Watchers has become one of the most talked about tickers on the market, and for good reason. Today's trading session was nothing short of electric. The stock rocketed up over 168%, closing at $0.3956 after opening at just $0.1481. With nearly 200 million shares changing hands, it's the kind of explosive move that sends a jolt through the trading community, with retail and institutional investors alike scrambling to make sense of the action. But beneath the surface sizzle, there's a complex, sometimes contradictory story playing out, a blend of reinvention, risk, and the relentless pursuit of relevance in a rapidly changing industry. Let's start with the fundamentals. W's revenues for 2020 clocked in at $785.9 million, a figure that's respectable but down from previous years, reflecting the company's ongoing struggle to adapt to new market realities. The company posted a staggering net loss of $345.7 million, driven largely by non-cash impairment charges as it reevaluates the value of its legacy assets. Subscription revenues, once the bedrock of the business, are on the decline, but there's a glimmer of hope in the clinical segment, which grew an impressive 58% year-over-year in the fourth quarter. Gross margins are inching higher, and management is in full-on cost-cutting mode, targeting $100 million in annual savings by the end of 2025. The last quarter even saw a swing to positive operating income, a rare bright spot after years of restructuring and leadership turnover. But let's not sugarcoat it. The risks are real and substantial. W's market cap, even after today's rally, sits just above $31 million, a far cry from its former glory. The stock is still down more than 80% from its 52-week high up to $0.35, and the company continues to burn cash at an unsustainable rate. Subscriber churn remains a thorny problem, as consumers flock to digital-first competitors, and the weight management industry is appended by the rise of GLP-1 drugs like Ozempic and Wegovy. The company's price-to-earnings ratio is deeply negative at -0.9, and its EPS stands at $4.34, underscoring the ongoing losses that have plagued the business. Analyst sentiment is, predictably, all over the map. Some see the seeds of a turnaround, pointing to the company's aggressive pivot toward clinical weight management and digital health, as well as its cost discipline and improving margins. Average 12-month price targets hover around $3, with some bullish outliers projecting double-digit gains if the turnaround gains traction. Others, however, remain deeply skeptical, warning that bankruptcy risk is still on the table if WW can't stabilize its revenue base and get its debt under control. The upcoming earnings call on April 30th is being watched like a hawk, with investors hungry for any sign that the company's clinical strategy is gaining traction and that subscriber trends are improving. The company's leadership is betting big.